Okay, so welcome to this our accounting class. Here we're gonna prepare ourselves to go into the concepts of accounting as relates to the accounting equation. This is critical for us to have a good understanding of the pillars of any accounting system. Any financial statement or has these pillars, as well as the income statement has these pillars. I would consider that there are 5 pillars to any accounting system or accounting software. Core pillars. There are others, but we can categorize them in four areas, and in 5 areas rather. There are 5 main pillars in terms of accounting. But for now, we're gonna look at the accounting equation, and the accounting equation has 3 main parts. So let's have a look at this PowerPoint slide. Okay, so we're gonna have a better understanding of the accounting equation. So that's our objective. We're gonna look what's an asset. We're also gonna look what is a liability, and we're also gonna look at what is capital, and then we're gonna conclude. So it is critical for us to have a good understanding of the accounting equation, so we have a good appreciation of the principles required. Okay, so sorry for that little break, but I needed to do a little break. But yeah, so we're back there. So we're gonna look at what's an asset, what's a liability, what's capital. These are the 3 pillars to accounting and the preparation of especially the balance sheet or the statement of financial position. So this is quite critical. Now let's move forward. So we need to look at what's assets. An asset is something that the business owns or are in the process of owning. And we can say, for example, a car, money, house, or building. So we can consider that to be an asset. Okay, so these are examples of assets. So we know a car is an asset. We know buildings are assets, etc. And also we could say money. Other assets, we have money, and we have stocks and bonds are assets as well, and the intent is for them to appreciate over time, so increase in value. Now in terms of liabilities, we look at that which is owed. So someone is a financial obligation, so we owe a third party. So it could be a loan, it could be a mortgage, it could be a credit card. These are some examples of liabilities. Now, in terms of capital or owner's equity, and it is critical for us to define this, it's defined as that which is defined as the asset, or which could be finance or money that the owner invests in the business. Okay, so he or she could invest money in the business. He or she could invest a building in the business. He or she can invest a car in the business, providing those investments have no lien, which means they do not have a debt attached to them. If they do have a debt attached to them, it becomes a personal debt in addition to a business debt, and unless the intent is to transfer the asset as well as the debt into the business. But traditionally, or ideally, the investment in the business should be free from any lien, if the intent is for it to be the owner, because owner's capital should be free from debt. That's the intent. So now let's look at the accounting equation. The accounting equation says asset is equal to liabilities plus capital, or asset minus liability is equal to capital. So this is one of the critical ideas in terms of accounting, fundamental, for us to be able to grapple with the idea in terms of the accounting principle. Now let's look at the example. Let's say we have this person who's John, who owns a car worth 20,000, but he owes or has on finance, there's a liability element of 15,000. So the asset is 20,000, which is the car, but he owes 15,000. Now let's try to apply the principle here. So the asset is 20,000. The liability, which is the debt element, is 15,000. Therefore, by default, to balance the equation, we would have 15,000 plus 5,000 altogether gives us 20,000. So the initial asset is 20,000. The liability or the debt element is 15,000 plus the capital, which gives us the total of the liabilities plus capital gives us the 20,000. So the debt is 15, and then the capital is 5,000. And we can rearrange the equation in this way. So asset, which is the car, minus the debt, which is 15,000, gives us a capital there of 5,000. So this gives us the critical elements in terms of the accounting equation. Now, if, say, another example, if John owns a building worth 200,000, but he owes the bank, which he has a mortgage here. Well, in this instance, is a he has a mortgage of 150,000. Now we're going to apply the equation to see what's the capital element. Therefore, the asset is 200,000. The liability is 150,000 plus capital, which is 50,000. Okay, so therefore the asset being 200,000, the debt is 150,000. By default, the capital would be 50,000. All right, so 150 plus 50 gives us 200,000. So to balance the equation, with an asset of 200,000, and we can rearrange it like this. Hopefully, you would have done that quickly. So asset is 200,000 minus the liability of 150,000 is equal to 50,000 in capital. Now, we have basically gone through the core concepts of asset, liabilities, and capital. We have defined what an asset is. We said an asset could be a building, land, car, money, investments, etc. We identified what is a liability. A liability is a financial obligation, which means we owe the bank, we owe someone, we are obligated to pay. And we also looked at what's capital, which is the money that is invested in a business. Invested in a business by the owner with the intent to get a return at some point in the future. This investment should be free from liens, so it should be unattached. No debt should be attached to this, because the capital is meant to be the owner's equity in the business. So these are the three core areas in terms of the pillars to build a business. Hope that you have a good understanding. If you have any problems or lack of clarity on anything, please leave your comments below. Thank you for listening, and look out for the next video.